Is now starting. All attendees are in listen-only mode.
Hi, good morning, everybody. Thank you so much for joining us today for our quarterly webinar series titled CIO's Corner, Quarterly Update with our Chief Investment Officer, Chris Gauthier. For those of you joining us for the first time, my name is Amanda Sylvia, and I'm the Client Service Associate for Stonehearth. And I've been with the firm for four and a half years or so, and my primary role includes client service, marketing, and compliance. I would just like to start off with a few housekeeping items. On your GoToMeeting taskbar, you should see a section titled Questions. Please feel free to submit your questions throughout the course of the webinar. I will be monitoring all of your questions and will ask Chris to answer as many as he can at the end of the webinar. If we do happen to run low on time and we're unable to get to your question, Chris or myself will reach out to you directly to make sure we can get your question answered. Now I would like to introduce our speaker for today, Chris Gauthier, Stonehearth's Chief Investment Officer. He brings more than 15 years of investment management experience to our firm, working with both institutional and individual investors. He is responsible for setting the firm's overall investment policy and strategy, including directing our asset allocation, investment risk, research, and portfolio management functions. Chris, thank you so much for speaking to us today.
Thank you, Amanda, for that wonderful introduction. And hello, and thank you all for joining us today. Again, like Amanda said, we're going to take a deep dive into the economy, into the financial markets, and kind of see what the second quarter of 2019 tells us about what may happen as the year unfolds here, as we move into 2020. Really, when we look at the year, it really has been a great start to the year, at least from a financial asset return point of view. In fact, if we look at the data, we're off to the best start to a year in over 2 decades. We haven't been this strong since 1997. And it's been pretty broad-based with almost all asset classes showing positive performance. And we're going to talk a little bit about that. Is that really an outcome that we want? Is that the normal outcome, or is there something wrong with that? Or is that telling us something that's going on in the marketplace? But before we take a look at the deeper dive into this performance, let's take a look at what we'll be covering today. So what we're going over today, we'll go asset class performance, basically what's happened, because I do think in order to understand where we're going, it definitely helps to know where we've been. We're going to go over the investment environment, take a look at a few charts that we're looking at, look at the economy, the equity market, the fixed income market, and then finally we'll end with portfolio positioning, where we are positioning our clients' portfolios to take advantage of what we're seeing in the marketplace. So with that, let's look at the performance for Q2 2019. As we stated at the beginning, most asset classes were up, but there definitely were some clear winners in the second quarter. And we look at that far left-hand side, those are the best performing asset classes in Q2 2019. And we see definitely gold and treasuries were definitely the leaders, with gold going almost up 9% during the quarter, which is very interesting performance to have in a quarter where the S&P is up almost 4%, risk assets performing well, which tells you that everything's going well. Why are the traditional safe haven, gold and long-term treasuries, assets that tend to perform well when things aren't going well in the economy, doing so good? You don't often see them rise with risk assets or leading performance when we're in this rising equity market. And I think we really have to thank Mr. Powell for this performance. We may not be thanking him 6 months from now or a year from now, but at least for right now, his interest rate policy is really driving this performance across the board, and we don't think it's sustainable. We look at that right end, the ones who really didn't perform well, and again, we just looked at a few, the dollar and oil. And oil is just beating to its own drummer right now. It's up 5% one quarter, down 3% the next, up 20% this month. It is just going all over the place. A lot of that has to do with geopolitical risks. You saw all the news about the tankers in the Gulf. There's really no way to invest in that or hedge against that. That's just stuff you have to react to as it happens. And also with the shale boom in the US, so I think the oil market's really adjusting to this new economy where the US is the leading swing producer now. It's not so much the Middle East. So again, we don't think oil is an investable asset class. You think you're going to have increased volatility, but given our outlook, it's going to be lower for longer. And if we look out 5-10 years from now, oil should be lower as we move to a more carbon-less economy. That's what we all hope we do. So taking a step back, take a little bit longer term view, looking at 1 year, nothing really changes. So again, expanding this time frame, it does little to change the overall picture, as we still see the traditional safe haven assets leading the way with bonds, gold, long-term treasuries. We see min vol over there, that light blue line all the way over to the left, almost 19%. That is a ETF that we hold in client portfolios that tracks the lowest volatility portfolio in the equity market. So it tracks the equity market and it creates a portfolio with a low volatility given constraints tied to the S&P 500. So it's an S&P 500-like product, but it's created a little bit better since it uses volatility rather than market cap to weight its holdings. And again, that is a traditional safe haven. So when markets are weak, markets are volatile, fluctuating, you usually see this min vol product outperform. You can think of it as Procter & Gamble, Kellogg's, Colgate, things that you have to buy. So those kind of safe havens, utilities. So again, this really is telling us that something is not right. But again, looking from a portfolio standpoint, looking from an investment standpoint, all in all, there's not too much to complain about from a performance perspective. But when we take a step back and we look at it in terms of the economic, how it affects the economy, what it looks like for the future, maybe a little bit different view emerges. So when we take a look at the different risk investment landscapes out there and we look at it from multiple lenses with a primary focus on risk, we see things a little bit differently. So before we jump into a little bit things we're looking at, let's take a broad view of this expansion. What we're looking at here is the length and strength of expansions. When we look over here on the left, what we're looking at is going through his history, what has happened during expansions. So the average expansions lasted 48 months and an average recession has lasted 15 months. And what we're looking over here on the right is all those expansion periods and how long they've lasted, how strong they were. So up here on the left, this is how strong they were. To the right is how long they last. What we're looking at ours right here is this light blue line. This is the current expansion. This is as of June 30th, 2019. So as of yesterday, we have officially become the longest expansion in history. There is one difference to that. It's really one of the weakest expansions we've ever seen in history. So we look over here on the right and look at the up and growth rate. Some may have been shorter, but we saw a lot higher growth rates. It's interesting. Again, I think we're going to go through and look at this data. We can see why we think this is, why this expansion is not translating to greater economic growth, and we think there's clear reasons why this isn't happening. The other thing to notice too with this is you hear a lot about we're near the end. Expansion's been so long, we have to go into a recession. Now that is true. What they don't add to that is it's a timing. This could go on for another 2 years. Because expansions don't die of old age. So we look at through history, they just don't die because they're long in the tooth. They die because something tips them over. Now, the longer they go, the more likely they are to fall. It's just a simple mathematics because we believe in mean reversion, but it doesn't mean it's tomorrow. It doesn't mean it's next month. It doesn't even mean it's next quarter. It could be 5 years from now. It could be 2 years from now. So again, when we look at it, be wary of people who say we have to go into a recession because it's been so long. We don't. Something has to tip us. Something has to move us into there. And we take a look at the end of the presentation at our risk model that's going to help us kind of discern through the tea leaves, is that risk rising that we're heading to a recession? Definitely not just because of the length. So Fed interest rates. I'm sure we all heard about the interest rates on Wednesday. The Fed cut 25 basis points. This chart doesn't account for that. We put this together as of June 30th. So when we look right here, the current rate is, and it's a range for them. They don't actually set a target rate. So the range is between 2 and 2 1/4. Before that, it was actually 238. That accounts for the 25 basis point cut. We saw the market react very negatively to this. And again, why? Expectations. So what we're looking at this chart here, we can figure that we're right here. So before Wednesday, the market, which is everybody investing, expected this. So they expected rates low or wanted rates to go lower. The Fed, from the previous communications, has said they were going to do this. And it's always funny to see the market just trying to drive the Fed to do what they want. The Fed did cut, which the market liked, but he also said, this is not the start of a new rate cutting cycle. This is a mid-cycle adjustment. So that caused the market to say, maybe this really isn't happening. And that's why you saw the big sell-off. So again, he said it was a mid-cycle adjustment, not the start of a rate cutting cycle. And we really think, I really wanted to start off this presentation with the Fed and the interest rates because I really think this is the main driver of financial returns. Why we're seeing everything go up. There really just is not a lot out there to invest in. There's a lot of cash sloshing around. There is easy money, but it's not finding a good home, or what we consider a good home in the real economy. So this transmission process, you can hear me talk a lot about this in this presentation, transmission process. What the Fed's trying to do is to create an environment where money gets to the right place and we grow the economy with full employment with stable prices. That transmission process is potentially broken. We're not seeing inflation pick up. And the benefit of that easy money is really not finding its way into the real economy. In fact, as we're going to show, I believe it's getting stuck in the financial economy, which is not necessarily bad, but it's not really going to help the traditional economy and help the workers. We also hear a lot about there's no inflation, and that's why the Fed can keep rates lower for longer and they can lower rates. We don't see inflation. I do have a problem with no inflation. I have some children. Anybody who has children who have to pay for college anytime soon can say that there is inflation in college. We definitely see it there. Anybody who's been to the medical facilities lately and gone through all tests, there's definitely inflation there. And I think also the Fed's just not looking for it in the right place. We are seeing inflation. Where are we seeing inflation? Asset prices, particularly the US equity market. We are seeing inflation. Inflation is being transmitted. It's just not being transmitted into the right place. It's not being transmitted into consumer goods. It's being distributed into the financial markets. So again, we're looking right here at the S&P 500 going up through history back to 1994. And then we're just looking at the forward PE ratio. So again, a PE ratio is just price over earnings. So earnings you can think of as a denominator, what companies are making at the overall S&P 500 level, and the price is what you pay for that. So what are you paying for earnings? Are you paying $2 for $1 in earnings? You're paying 16 times. So right now we're paying 16.74 times in price for every dollar of earnings. Now, is that good or bad? Depends on history. We look out through history, the 25-year average is 16.19. It's at 16.74, so you can say it's a little overvalued. And then we look at the relative other measures we look at in terms of valuation. We look at the CAPE, Shiller's PE, which we really like. That takes that PE measure and expands it over a long time frame and takes into account inflation. And the latest reading on that is 30. When we look throughout history, it's 27. And in fact, when we look at this right-hand column, anytime you see a positive number there, that means that indicator is showing that the market is overvalued based on prior history. So other than this earnings yield, which takes into account bond yields, which we know the Fed is artificially keeping low, all the metrics say the S&P 500 is overvalued. Now again, it's not at extreme levels like we saw in 00, definitely not there yet, but it's definitely giving some signs that, you know what, it's a little bit stretched. And we think this is really where that transmission mechanism is happening. The Fed keeping rates low, the so-called Fed put, that inflation is translating into the S&P 500. So the S&P 500 is a group of 500 companies in the US equity market. So what are those 500 companies doing on aggregate in terms of profits? You know, are they earning their money? Is it maybe justified to be so high because the earnings are strong? So what we're looking here on the left-hand side, and we find is that companies are doing fine. Earnings are growing. So these are earnings going back in time, 1999, on a quarterly basis. Up and to the right is good. Down like this is bad. And we see that they are growing. Now, you hear a lot about this earnings recession. They're not growing year over year. We got to remember that we had the President Trump tax cuts, which gave a really artificial boost to earnings. So we have that coming. But when we look at the overall picture, up and to the right is good. Earnings are growing. We look at net earnings revisions. What is that? That's just analysts who follow these companies on a day-to-day basis. Are they revising up the earnings? Do they think companies are going to make more money or less money based on the new information? When we look right here, they think they're going to make more money. So again, we're seeing increased earnings. At the corporate level, we're seeing analysts getting more bullish on earnings, saying they're going to rise more than they expected. And then we look down here at the lower right-hand chart, look at the profit margins. So again, very simple balance sheet. Companies spend a lot of money, they get money in. What's that net that they keep? Right now, they're keeping about 11.2%. And we look out through history, that's a very healthy level. So companies' earnings are increasing, maybe not as much as we'd like, but they are increasing. Analysts are getting more bullish on earnings estimates going forward, and companies are making a lot of money in terms of profit margins. All good, right? Right. What are the companies doing with their profits? Since they're making, we see that they're making very good profits, earnings are rising, what are they doing? Well, number one, they're rewarding themselves and shareholders through buybacks. And we can see that right here on the left-hand side, where we go through time, look at all the individual buybacks. 2018, which is last year, was a record year. You look at this bright orange line right here. This is 2019. We're off to a bomb start, and we're going to head back to probably records again pretty soon. So again, they're paying themselves, which doesn't necessarily hurt the workforce or the real economy, but it doesn't really help them either, right? They're really rewarding themselves and shareholders. They're rewarding owners of capital, not users of capital. We look over to the right, and we look at capital expenditures, which is right down here to the lower right hand. And this, just look at this, I don't know what color this is. It's kind of a green line. I got to talk to JP Morgan, who provides a lot of these charts for us, and see if they can get better colors here. If you look right here, it was rising from 15. So again, just percent of residential fixed income capital expenditures, and we can see it rolling over. So they are investing, it is growing, but not as much as they used to. It's coming down. So it's that money they're making is not being reinvested in the business at greater and greater rates. They're either flat to down. We look up here and we say, okay, they're making money, that's a good thing. Why is debt increasing? So what this shows is the net debt amount they have to the income they're making. So again, we look through the growth rate. So small caps are growing their debt to EBITDA, taking on more debt than they're earning by 24%. At the other extreme, growth companies, they're taking on more debt, 70%, which makes sense. If you're growing, you need to take debt to expand knowledge base, expand workers, expand investment. But why is this increasing with all the money they're making? It's really fairly simple. Why not? With record low rates, the Fed keeping rates low for longer, saying they're going to keep them low, why not take on more debt? It makes sense. It's an easy way. People are willing to lend. People are searching for yields, so they're willing to lend to you at very low rates. But those proceeds they're getting is not being transmitted again to the real economy. Again, using for some buybacks. Not as much capital expenditures as you would like. What are they doing with that? They're giving it back to the owners of capital. Now, with all this debt going out there, is it a problem? Well, not now. Earnings are pretty good, but it's not looking good for the future. So when we look at this corporate debt, we can see over here, right here, on the left-hand side is government, which is right here, this brown line. Light blue, the household, think that's people, individuals, and non-financial corporate debt in this dark blue line is companies, everything besides banks, which is a whole different animal, and you can't include that in the debt numbers. So what we're looking at here is you can definitely see the debt rise before the housing bubble for the consumer, and they definitely delevered, and you saw that right here, you can see this big thing. But did the economy as a whole delever? Well, where'd that debt go? Did it just get wiped out? Looks like we just moved it over to the government. So again, it just got shuffled around. And then when we look at the corporations, you can see them really increasing debt, starting to ramp up after that recession. It came down, they battened down the hatches, and then with the rates so low, they really started to take on more debt. So when we look at this is one more reason why, you look at the Fed really leans dovish. Because with all this debt out there, it's not gone. It may feel like it if you're looking at your own debt, it's still out there. So if rates rise, it could wreak havoc on corporate balance sheets. And why do we say that? One of the charts to really look at that is this, is BAA corporate debt. What does that mean? This is investment grade debt, but it's the lowest rung. So when we look at corporations, you can do from real high-end, real top-of-the-line corporations, think Procter & Gamble, think Apple, AAA rated. They're pretty safe companies, all the way down to, the Netflix of the world, which are, a little bit dangerous. They're not generating enough cash to cover their debt, and they have to spend a little bit more on the interest rate. This rung, BAA, is the lowest rung before you move from investment grade to junk, which means higher interest rates. We're at record levels at BAA. Why does that matter for the future? Because if any type of interest rates go up, if the Fed decides to raise rates, if inflation takes off, and being able to cover their debt gets troubling, these move right to junk. They go right into the junk bucket, and a whole bunch of investors cannot hold junk bonds. So there could lead to dislocation in the bond market. And then when we look down here at duration, which is just a measure of risk that companies have. So duration, by definition, is for every 1% rise in interest rates, an equal 1% fall in prices of that instrument. So if you have a duration of 7.6, which it has a June 2019, which means that for every 1% rise in interest rates, that price of the bond could fall 7.6 and that much more difficult to refinance on your balance sheet. Because remember, most corporations don't pay off their debt, they roll over their debt. So once that debt comes due, and it's due next year, say, they just don't expire it. They tend to issue more debt. So they have to issue at higher rates. And can the balance sheet cover that? So again, we don't think corporations are doing the best they can for the economy by increasing their debt levels because they're rising risks and it's not being transmitted into the economy. How do we know this? Or why do we think this? I should say, because we don't know anything. It's the kind of thing. We talked about the transmission is broken, is we look at some cyclical sectors of the economy. So these four sectors have traditionally accounted for 2/3 of the change in GDP. But more importantly for our conversation here, they're really looking at investments that get translated to the real economy. So upwards to the left right here is residential investment. That's housing, houses being built, houses being furnished, buying refrigerators, all those types of things that are generated when a new house gets built or when a house gets sold. So we really want to see that take off. That really generates a lot of economic activity through the real economy. And when we look over time as a percent of GDP, so again, how much of the economy is happening, it's still growing, it's 3.8. But throughout history, it's been an average of 4.4. So even with the Fed at low interest rates, the economy so-called booming based on who you're listening to, a very strong economy, a great expansion, we're not seeing all that be transmitted to the housing market. When we look at motor vehicles down here, another big piece, again, a long-term investment. How do you buy a car? You usually take out a loan. What's the price of that loan? The Fed funds rate, or what the Fed is keeping rates at. That's at almost record lows. We should see a pickup in motor vehicles. We're not seeing it. It's still growing, but compared to what it has in history, not enough. So again, with rates at this low level, the transmission of easy money should be showing up in these numbers. It should be showing up increased housing demand in autos, but we're just not seeing it. Look over here at business fixed investment. We see a little bit of increase, but not this great. So again, if this economy is so strong and everything is going gangbusters, why isn't it be transmitted to traditional sectors that have driven economic growth in the past? We're still seeing economic growth, but not that robust growth. We think that transmission is broken. Another reason why we say that is that we look at the yield curve. And I'm sure you heard a lot about the yield curve. And what we're looking at here is the current yield curve on June 30th, right here was this blue line. Look at the 10-year at 2, given the recent rate cut and the price performance as of right now, August 2nd, I believe it is August 2nd, sorry. The 10-year is at 1.88. So we've seen a big drop in this. This yield curve is as of December 31st, 2013, and it's more of a traditional yield curve. And it makes sense. So if you think about it, all the yield curve is at going out multiple years, what it costs to lend money, or what you're willing to lend money at. So I'm willing to lend the government for 5 years back in 2013, 5 years at 1.76. If I want to lend the government money for 30 years, I'm going to ask for 3.96. Makes sense. The longer I lend money, the more risk, the more I want to be compensated. That's what we call a normal yield curve. What we see today is far from a normal yield curve, more of a flattening. And in even some places, it's inverted. If you look at the 3-year, so a 3-year, you can lend at 1.7, but for 2-year, 1.75. So I'm asking for less money to lend you for longer. Again, this is not the disease. This is a symptom. This is telling us something's wrong. It's flat, but not inverted everywhere. It's telling us something's not right. And you hear a lot of people talking about it's recession coming, it's telling us this. I think it's a bigger step back. What it's trying to tell us is that transmission mechanism that traditionally we've seen from the Fed lowering rates, going through to inflation, going through to wages, going through to investments, in a booming economy is broken. And if that's the case, and you follow it to its logical conclusion, and if it's true, then no matter how low the Fed lowers rates, it's not going to help the traditional economy. In other words, the Fed is just what we call pushing on a string. They can keep trying to shove money down the economy's throat, trying to force feed it, but it's just not finding its way to productive uses in the economy to grow this economy in a more robust manner. It's still growing, but not robustly. So when we look at the yield curve, we know that it has a major impact on the bond market. So again, everything's priced off of this yield curve in terms of how much risk you want to take. So what we're looking at here is the bond market and that word duration we talked about. Remember, we talked about duration. Duration is just a measure of risk, how much interest risk you're taking. The higher the duration, The more risk you have to rates rising, the more you could lose. And that's this brown line here, going back in time to 1976. And you can see duration, it has been higher in 76, 78, going down. But you really see since the Fed has starting its lower rate cycle in 09, and we came out of this crisis of 08, you've really seen the risk in the bond market rise. So we really see risks rising in the bond market, which is not necessarily bad. Again, we're coming out of economy, rates are low, risk can rise, but are we being compensated for that? And to find that out, we look at yield. So how much money are we getting to take on that risk? If we're willing to lend to you and take a duration of 5.7 years, which is what we're at right now, how much am I getting? Right now, I'm only getting 2.49% in interest. So looking at through history, for an increase of almost 20% in risk, I'm looking at almost 1/3 to a little bit less in interest. So I'm getting paid a lot less to hold bonds with an elevated risk level. We don't think this makes a lot of sense for traditional bonds. What we do think is that there are ways to maintain exposure to the fixed income market because you want that buffer, you want when the markets go volatile, you want that exposure while lowering this risk. And what we tend to look at is more funds that can adjust this duration and bring that down lower, but still maintain the fixed income exposure. So we still have a market weight to fixed income, which we'll see. We just think there's a better way to get exposure than traditional bond ETF to just buy the index or individual bonds. So we talked about the equity market, we talked about some of the economy, what corporations are doing, we talked about the bond market and the high debt levels. How does this translate to prices? And when we talk about prices, we always talk about inflation. This is what the Fed is aiming for, what we always talk about. The Fed wants inflation at 2%. Why want it at 2%? Why? Who knows? Somebody sometime, a long time ago, did a report, did a study and said, you know what, 2% is the right place, the right price for money. There's no rhyme or reason to that. It could be 4, it could be 1, it could be 8, but for whatever, the Fed has a theory that they need to keep prices at 2%. And if prices are not at 2%, then they have room to lower rates. So again, is the Fed getting that? Are they seeing inflation? Are they getting nervous about 2%? Going through history, this is the 2%. You can see, no, not really, not even close. It's kind of a little bit, headline CPI is 2%, and look at the core is right at 2, so right where they want. So what the Fed is saying is that we're not really seeing this inflation, but we are. We're just not seeing it where they're looking for it. They're only looking for it in this core CPI. They're looking for it in housing. They're looking for it in food. They're looking for it in traditional ways. They're not looking for it in financial assets, which is where we're seeing it. The traditional measures of inflation aren't capturing the financial and asset inflation we're seeing. So we know the Fed is keeping rates low. Traditional economic policy says that should give rise to inflation. We're not seeing that. Well, maybe that's due to employment, because how does employment affect inflation? What if there's no wage growth, no employment? Doesn't that equal no inflation? So again, the Fed is only one piece of it. What if jobs aren't growing? What if we don't see any wage growth? You know, maybe we won't see inflation because we don't have the ability to pay more for goods and services. Well, in fact, we're seeing tremendous job growth and wages are growing at a very healthy clip. And we look here at the unemployment and wages. Unemployment, this is brown line, since October 2009, again, very elevated level, but straight down. Unemployment is almost at record lows at 3.6% throughout the economy. We can argue whether they're the right jobs or not, and I can have a conversation for hours and hours about that, but the net number at the overall economic level, there are more jobs, which means people are getting more money. Is that translation to wages? And we can see this light blue line. Yes, it is. They're growing at a very healthy 3.4%. Historically, they're growing at 4.1, so a little bit lower. That has to do with a lot of the labor supply and the new economy, but they're still growing. So again, when we're looking at what the Fed's trying to do and get to those stable prices, increase the economy, we should see it come through to low jobs, which we are. We should see it to wage growth, which we are, which should translate to inflation, which we're not seeing, and translate to the real economy for that robust growth in the housing and auto sector, and we're not. The transmission cycle is broken, and we really believe this is a theme that's going to come back to bite the Fed in the long term because they're just really pushing on the string. And then we look at it, is it different this time? So again, I've talked a lot about what the Fed's doing. It's going to be different this time, and I've always been a big believer in, it's not different this time. That's most dangerous words in the financials. They are, but sometimes when you look at the data and we look at the history, it really is different. So before we get into our risk model, what I want to show you here is interest rates and inflation. There's a lot of information going on here. I'm going to break it down as simply as possible to give you a high level. What we're looking at is throughout history, the end of rate hiking cycles by the Fed. So what is a rate hiking cycle? It's usually at a crisis level or inflation, and the Fed starts raising rates. So the latest cycle, which is down here, right here, June 30th, 2019, this is the current rate cycle. It started way back in 2009. So again, it's been going on for a while, and it ended officially Wednesday when the Fed raised rates. When the Fed lowered rates. Sorry, little Freudian slip there. They should be raising rates, but they're not. When they lowered rates. So again, given going back in history, what has been going on in the marketplace when they've lowered rates before? Way back to 1984, like a nominal funds Fed rate was at 11%. It was at 9% in 88, 5, 6, kind of get the picture. It's at 2 now, so really low. And without going to all the numbers, you can see that if you average all these past cycles in, that traditionally, when the Fed has begun lowering rates, CPI was at 3.35. Right now, it's at 2. So again, it's a little bit low. Look at the real Fed funds rate, 3.32. So the real Fed funds rate is much higher, takes into account inflation, much lower now. We look at the 10-year Treasury, what's it yielding? In history, they've put it at 3.91% before they started lowering rates. Right now, it's at 0. So again, you don't want to always say this time is different, but sometimes when you look at the data, it is different. So what we have to understand here, the Fed is not infallible. It is not a hard science. This is not biology. We are living through one big economic experiment. And we really are, because as we've seen before, this hasn't happened before. We haven't been here when we've been on the edge of lowering rates. So given all this, knowing that's a little bit different, how does this affect the portfolio? Well, before we go into that, is how we look at judging risk in the marketplace. We look at it through multiple lenses. And what we think we do and we accomplish is that we're able to look at it through multiple lenses to defend against those blind spots that we see, like just focusing on the Fed funds rate. You would say you have one portfolio, just focusing on the economy. But by taking into account technical, valuations, economic, and qualitative, we are better able to position your portfolio for whatever comes ahead. So what we've gone over this before, is a Stonehearth capital market risk model. And we break it down into basically a few indicators. Now, each one of these indicators has 4 or 5 sub-indicators under it, and I'm just aggregating that up at a kind of, median level. If anybody ever wants to go into all the details and all the indicators, we're happy to go through that. So what we're looking at here is our models from 331, the last time we spoke, to 630. And we can see at the overall level, last time we spoke, we're at neutral, and it's positive. Some people may find that strange after the presentation I just gave and everything. But again, it's not how I want the world to be. What we're looking at is how the world is. And when we look at the world as it is, it's not too bad. Look at technical structure. And we're looking at structure as characteristics that have defined bull markets in the past. Mean reversion, a lot of companies trading above the 200-day moving average. We have all that up, and that's a positive too. We look at technical reversion. Is the market overvalued? Is it going up a little bit more than it should? Is there a sign that it's going to turn? That's still positive. The big drawdowns valuation, we talked about that. It's a very negative on the valuation. We're at a high risk level due to valuation. Economic picture, and this is where it kind of gets a little bit, it's very positive at 3. And I'm going to go into this more detail on those indicators because I think it matters after the presentation I just gave. And the qualitative. And the qualitative really is the Fed's keeping rates lower for longer. Now, again, we talked about how I think the world should be and how the world is. I don't think the best course of action for the Fed right now is to keep rates low or lower rates. But they've decided they're going to do that. And in that base case scenario, at least in the short term, that has tendency to lift financial markets, which is what we're looking at here. Financial markets, not the true economy. So for now, that maintains a positive influence on our model. Add all that up, we get to a positive 2. What we see going back in time, you see this bouncing around. So what does this tell us? You see it's 0, then it went to positive 2, negative 2. Didn't really make changes in our portfolio because we're in this, what we call the waiting place. So if my daughter just is ready to go into high school this September. She graduated 8th grade. We gave her the All the Places You Go by Dr. Seuss, which I'm sure a lot of you have given your children or grandchildren. And they have what they call the waiting place. And I think that's really where we are now. And that's what we're inferring from our model, is that we're waiting for this to break one way or the other. And in that time, what we should be doing is dialing down risk, which we did back in the third quarter, 2018. We took off some equity exposure and put it into cash, and we're maintaining that through the second quarter here, and just be ready to react to whatever the market has. So again, we're really waiting in the waiting place, waiting for something to happen. So I do want to dive into the economic picture a little bit more to our sub-indicators, so you really get a picture of why we think it's so positive. And it's good to remember when we look at our economic indicators, we're not trying to look at what happened. So when we look at the GDP number, that's a great number. It's a great overall barometer of what the economy did. It doesn't really tell us much about what's going to happen. When we look at other indicators, they usually tell us what happened, not what's going to happen. It doesn't give us any reading on what's going to happen. So our indicators have to be based on economic rationale, a reason why they work, but also they have to help us understand what's going to happen in the future, not just in the past. So the first one we look at is employment, and this is just this 3-month smoothing average of jobs. And what we're looking at, we need to see job creation. We saw back in 08, one of the big problems was we lost all these jobs, and we had a nice comeback, fell back down, and right here seems to be flatlining, but still, with this being 0, we're still creating a lot of jobs. Now, again, we talked about may not be the right jobs, but jobs are still being created in the economy, which means there's more money for people to have in their pocket, which should mean more money to spend. So again, as we see employment and we look out, this portends well for the future economy, because people are still getting jobs and are able to get jobs. The next one we look at is manufacturing. Manufacturing, we look at the PMI, the ISM manufacturing PMI. This is a composite index. It's what we call a diffusion index. What does that mean? It asks a whole bunch of questions to businesses, purchasing managers, and they basically ask a list of 30 or 40 questions, and the answers that the companies can give are getting better, staying the same, getting worse. So an example, are you going to order more this quarter than you did last quarter? And they say either say, we're going to order more, order the same, or order less. Add all that up and you get a number. Anything greater than 50 means we're in expansion, which means people see things getting better. Again, the higher the better, right? The more positive, the better. And we do see a big roll off here in this PMI. But again, we cannot predict the predictors. This is predicting what's going to happen in the future, and we don't have nothing to predict whether this keeps going down, this bounces up. All we can look at is that given where we are today, and these companies looking out at the next few months, next 6 months, next year, they're positive that we're in an expansion. So when we look at manufacturing, which is a big piece of the economy, we see that we're still in expansion mode. If this was to drop below 50 and then keep going down, then we'd have a different point of view. But for right now, this is still a positive influence on our model as we see manufacturing in expansion mode. The economy is expanding. And last, and kind of my, the one I kind of think is the most important, is we're looking at new orders. So these are new orders by companies. So new orders, excluding defense, because defense, is very cyclical, and aircraft, because, aircrafts cost hundreds of millions of dollars. So one of those can really skew these numbers. Again, we're looking at a 3-month smoothing average, and what we're looking at is the rate of change year over year of new orders of goods that are meant to last a long time. So the way to infer how that translates to the economy is you're confident. You're willing to invest in something that's going to last you a long time because you're confident that we're in expansion mode. And we're seeing that right now, that orders are increasing 2% year over year. So that's still showing that we're expanding, that companies are investing, and that they're willing to purchase stuff that lasts a long time. That is all positive influences on the market and on our model. So again, it's not all rosy out there. We do see a positive technical picture, but that changes from month to month. You've seen that very volatile technical picture. Again, every tweet by President Trump, it pushes it down a little bit. Every sign that the economy is going better, or the Fed's going to lower rates, pushes it up a little bit more. Definitely an overvalued picture. We see the overvaluation across the board. We do think there's valuation pockets, and we'll get into that in 1 second, but where we see some valuation support. And then we're also looking at it from a qualitative point of view, that the Fed is going to keep rates lower for longer, and we may not agree with that, but that helps financial markets. And finally, economic picture, we're still seeing growth. And what we're looking for is no growth. That's what we're really looking for in our risk model, because that causes those big sell-offs in the marketplace. And as long as we're showing signs that growth is continuing and will continue in the short-term future, then we're going to have a positive economic indicator, which gives a positive influence to our model, which is why we're still staying with our current positioning. So we still think things are all right, just not great. In that type of market, where do you want to be positioned? Well, the first thing is you want to be very diversified. Again, we still think diversification is the only free lunch, that having your assets spread out amongst different asset classes and not concentrated in one risky asset class like large cap US equities will bode well given the dichotomy we're seeing in terms of what the Fed's doing, the tweets from our president, the trade war. So a very diversified portfolio helps. When we look at the asset allocation, it hasn't changed from last quarter. So we're still underweight equities. Again, we just think the valuation picture is getting a little bit elevated, a little bit ahead of itself, and that we could potentially be seeing a pullback in equities. Really think it's really concentrated in the US, so we can see that we're underweight US equities. We overweight certain pieces, so we do like value stocks. Again, we still think cheaper stocks are going to outperform expensive stocks. We still like quality. We still think strong stocks are going to outperform weak stocks. But we think overall, you want to reduce your U.S. equity exposure. You don't want a full exposure to U.S. equities right now, given the valuation picture. Internationally developed, we're neutral. This is really driven by the Brexit. We do think it's real. We do think the re-election of Boris Johnson is going to cause some troubling aspect in the international economy, and you could see some dislocations in the marketplace. So we pulled that in. We're neutral. But what we're looking for is really once that dislocations happen, international may provide some good opportunities given where the dislocations happen, as we see most investors overshoot on the upside and the downside. So we're really looking to take advantage once that happens and maybe increase that once that Brexit happens. Emerging markets, we've liked for a while. We still like, we're overweight that. Again, why? Valuation. It's trading at a much cheaper valuation relative to its history. It has fastest growing population, so it really is positioned well that it doesn't have to be perfect for it to really perform well. And we're starting to see signs of that now, that emerging markets are kind of coming through, so we'll overweight that. Fixed income, we're underweight only by a little bit, but again, given that risk we see in the marketplace from duration, we don't see taking excess risk in the bond market. We do think where you get exposure in the bond market is really going to matter more than how much exposure you have. So again, funds that can manage a duration like BlackRock Strategic Income, which we hold, or Double Line, which is a mortgage fund, which has a little bit less duration, or some floating rate in our more conservative portfolios that adjust when rates go up, will really serve clients well. Definitely overweight cash, waiting for that dislocation to happen. We don't see any opportunities right now. But again, we're always looking, and as our risk model points in our direction as to what's showing up as attractive, then we'll be able to deploy that cash. Or maybe it goes the other way. Like I said, we're in the waiting place. We don't know. Maybe it deteriorates a little bit more. The trade war intensifies. The Fed loses control of inflation, and we can build up that cash. But we do think having a little bit of cash on hand right now, willing to invest when needed, is a good. And we still like alternatives. Again, given the low return we expect over the next 10 years, given the volatility we're seeing, and we saw that yesterday where we were up almost 1% midday, one tweet from President Trump, and now we're down 1%. So again, some of our alternatives were actually up yesterday, which kind of helps and gives me, that it makes sense to have some alternatives in your portfolio to prevent some of this volatility that you just can't defend against yourself. So that's basically where we stand. Again, we got a strong technical picture with a decent economy that's growing but not great, and it's not growing great for everybody. There really is a tale of two cities, with owners of capital benefiting much more than users of capital. So I think that hopefully will change. Very highly risky bond market with the Fed going through an experiment, and given all that, you really want true diversification in your portfolio, and you want to be able to adjust your risk as the data points to it, and that's where we stand right now. So with that, I'd like to turn it over to Amanda to see if there's any questions in the queue, and I'd be happy to answer any questions you have. Amanda?
Hi, Chris. Thank you so much. Just as a reminder, you can use the questions tab on your GoToMeeting taskbar to send in your questions, and we'll try and get to everybody's. The first one I have is, do you think that the slow growth of the housing and cars has to do with millennial lifestyle choices and large student debt among young people?
Good question. Yeah, so again, when we look at that and we see it's not growing as robustly as it has in the past, we look at what's different or what's the same. And demographics have definitely changed in the US. And I definitely think that student debt is a problem for a lot of people. We do see people staying in their houses longer, so there's longevity risk now. There's a lot people living a lot longer than they have in the past, which means they can tend to stay in the houses a lot longer. So I think that has an influence on it. But I think, again, when we look at all the data and we look at the data points, I think the biggest driver is that a lot of people remember 2008 too. They remember how they looked at the abyss. You know, maybe they lost their job, maybe the house was underwater, they couldn't afford their mortgage. And I think that does change behavior a lot. So people react to that, people remember that. And I always talk to, when I'm out there talking to clients, you know, I remember my grandfather, he lived through the Depression. He passed away, you know, a few years ago, and we're cleaning out the house, and we literally found money everywhere. We found money in the couch. We found money in the trunk. He was hiding money all over the place. And I talked to my grandmother. I said, "This is, you know, why do you have money?" He goes, "Well, he just didn't trust banks." So even 30, 40 years after the event, he was still impacted by that psychological effect of the Depression. And I think, oh wait, had a lot of that effect on a lot of people. So I do think that changes behavior. I do think people are paying down debt more and saving, and that has an impact. But with that, even that being the case, the solution we have in the marketplace is to lower rates is not going to help that. So again, with the Fed keeping lowering rates, trying to generate that transmission mechanism to move that money around, they're not solving the problem. It's like a doctor trying to cure the wrong disease. Someone having cancer and they're trying to cure syphilis or pneumonia. Bad choice. We're trying to cure pneumonia, and the patient has cancer, and that's what the Fed's doing. So that's what we see. So it could be, and I think it does add to it a little bit. But again, the bigger takeaway for me is that what the Fed's doing is not going to work.
Chris, the next question I have is, your risk model and the data I am seeing is showing a strong economy. Why did the Fed lower rates?
Good question. I'm with you. They shouldn't have. A couple reasons. One, I think it was the safety net. So when we look at who's in charge, it's Jerome Powell. And we look at what's happened over the past couple of years. Our President Trump, has been pretty vocal about wanting lower rates. He's consistently tweeted about it, consistently said that lower rates will lead to greater economic growth. So when we look at what Powell's in charge of, he's in charge of that rate level, whether to rise it, keep it the same, raise it, or lower it. He's a career economic professor. He can't really compete in the social media sphere with our current president. He does not want to be blamed for anything bad happening, which he will be, because the president always set the groundwork. So I think some of it is reacting to the presidential tweets and being afraid a little bit about his legacy. Because again, if he didn't do anything and say the economy starts tanking, the president's gonna be out there tweeting, Jerome Powell didn't do his job, he caused the economy to tank. 20, 30 years from now, when we look at the history books, are you gonna hear about those tweets and how Jerome Powell caused a recession? So I think a lot of it's legacy and a lot of it's reacting to outside noise, so not really focusing on the data. And sometimes you kind of put these people on a pedestal and think they're not human and just looking at the data. They're human. They're affected by the noise out there in the avosphere or whatever in the economy. They're affected by the noise of people. They're affected by social media, and they react to it. And I think that's what he's doing. So I think what he did was he tried to lower it as little as possible to satisfy one constituency without really lowering it more and hurting another. And that's where he said it's a mid-cycle adjustment and not a start of a rate lowering cycle. Because I really think he doesn't think he should be lowering rates right now, but really has no choice given the current political environment. So that's a long way answer of saying I think he has other influences other than data driving his decisions right now.
Chris, how does the trade war influence your view on the markets?
Yes, and we saw a great impact of that yesterday, and we saw the trade war kind of raise its ugly head again and kind of kick the marketplace down. We watch it like everybody else. How do you predict what the outcome is? I don't know. You have President Xi from China on one hand, President Trump from the US on the other. What they're going to do, what they're going to agree with. There's no economic model, no financial model out there that I know of that can kind of predict what they're going to do. So like everyone else, we're watching it very closely. We're following it on Twitter. We're following it in the marketplace. And we're really letting the data that we're seeing come through in the economics drive that decision-making process. So you saw tweets, tariffs are going up, tariffs are going down, markets gyrate. We're going to ignore all that noise and really focus on what the data is telling us, because we have data points that tell us if it's really impacting the true economy yet. And what we're seeing is that, yes, it is impacting. We saw some slowdown in the economy. We saw some tick down in manufacturing. We still see jobs being created, but not as robustly as before, but we're still seeing growth. So we're really going to let the data tell us. So the trade war doesn't have a direct impact. It has an explicit impact that we're watching it, and it makes us more concentrated on the data. So when we look at these things and their outcomes can never be predicted, the future is never 100% sure, what we can do is fall back on the data and let the data that's unemotional, unbiased, drive our decision-making process.
Chris, I think in respect for time here, the rest of the questions we can certainly follow up with each person individually to answer those questions. Just want to remind everybody, if you'd like to sign up for our next webinar, which is Monday the 26th at 1 p.m., that'll be with our Senior Financial Advisor, David Giuliano, on trusts. You can go ahead and sign up for that on our website at www.stonehearthcapital.com. Chris, thank you so much for joining us today. Lots of information on the quarter, so thank you so much.
All right, thank you. Thank you, everybody.
Have a great day. Bye-bye.
Bye.